Hello, welcome back to another YouTube video. We're going to be looking at cash flow forecast today, the first financial statement of this whole A-level business course. All I ask for is a subscribe and like, and let's get straight to the video. Now there's a few definitions you need to know, which we'll just go through now. Cash flow forecast, this shows all the cash coming into and out of a business over a period of time. Cash inflow shows all the cash coming into a business over a period of time. Cash outflow, showing all the cash going out of a business over a period of time. Working capital, the amount of cash a business has available for day-to-day spending. Debtors are people who owe the business money, and the receivable is the money that is owed to the business. So, for example, let's say Apple sell me a product, but I don't pay for it straight away. I pay for it later on. That means I'm a debtor to Apple. I owe them money, and when I pay them that money, it's a receivable. And the opposite, you have creditors. These are people who are owed money by the business. So Apple, again, let's say they buy raw materials from the supplier, but they don't pay for it straight away. They pay for it at a later date. The creditors are the suppliers, and payable is the money that the business owes. So again, Apple, when they actually pay that money to the suppliers, that's the payable. Um, Generally speaking, you just need to know the definitions: cash flow forecast, cash inflow, cash outflow, working capital, debtors, receivables, creditors, payable. So just get to know the definitions, and that'll be good for the exams. As I said, there's a lot of money flowing into and out of a firm, so a cash flow forecast will help a firm control its finances, and that's generally what you need for this slide. Once you get the definitions, the rest of the video and later chapters in the whole A-level course, it will be very easy to understand. As I say, my whole point of this YouTube account and video is just give you the points for you to go and take and revise, so I don't waste your time. Let's move on to the next slide now. Now, cash flow forecasts allow firms to make decisions. Established firms can use past data, whereas new firms, they will need to consider the firm's capacity, consumer trends, and experience of similar firms to make actual decisions. Now, generally speaking, the main decision is that managers can use cash flow forecasts to make sure they always have enough cash. This will allow the managers to realize when they'll be short of cash and may need to take a loan. In addition, if they have too much cash, they can maybe use some and invest it into a business. Also, cash flow forecasts can be used to persuade sources of finance to give the firm money. So a bank may see a firm as safe if they can provide an overview of where all the money is going. Therefore, there will be the business will be able to obtain a loan from the bank, and maybe even at a lower interest rate. However, cash flow forecasts aren't always accurate. Businesses in dynamic markets will see a lot of changes in their environment, which can affect their cash flow, and they can sometimes be unaware of where everything is going. Then also, the longer the time period over which the cash flow forecast is made, the less accurate it will be. This is generally because you don't know what the future is going to hold. For example, if you did one just before COVID hit, no one really predicted that. And also, all of this can lead to inaccurate forecasts, which can have disastrous results. A firm that maybe isn't monitoring their finances properly can run out of cash and end up insolvent because they don't have enough cash to cover their costs. Hopefully that makes sense. From this page, I would just say you basically need to know all of this again, all the bullet points. So just make notes in your own time and slowly revise it. You'll get comfortable with the information. Now for the last slide, we're going to look at an example of a cash flow forecast. This is an example on the top left, and sometimes it may be drawn a little bit different in your exams, but it will generally have this sort of structure with the cash at the start of the month, which may be known as the opening balance, the cash inflows, outflows, net cash flow, and cash at the end of the month, which is sometimes referred to as closing balance. Now there's a few formulas you need to know, such as net cash flow, which is inflow take away outflow. Sorry, cash inflow take away cash outflow. If we look at January, for example, the cash inflow is 20. Take away 25, you get minus 5. So if you look at the net cash flow for January, it's minus 5. If we do the same for February, 25 take away 30, minus 5 again. Also, the cash at the end of the month, which is usually sometimes called closing balance, equals the cash at the start of the month plus net cash flow. So we take January as an example. The cash at the start of the month is 25 plus the net cash flow, which is minus 5, which just means 25 minus 5 equals 20. So if you look at the cash at the end of the month for January, it's 20. We'll look at maybe April now for net cash flow and cash at the end of the month. So April cash inflow is 15, cash outflow is 10, net cash flow is 5. Then cash at the end of the month is added at the start of the month of April, which is 5, plus the net cash flow, which is 5. So the closing balance or cash at the end of the month is 10th April. And lastly, the cash at the end of the month is the cash at the start of the next month. So for example, if you go back to January, the cash at the end of the month is 20. So the cash at the start of the month for February is 20. Look at February's cash at the end of the month is 15. And look at March, cash at the start of the month is 15. That's it for today's video. Hopefully that makes sense. If not, just rewind the video and watch it over again. As I like to say, I just get to the point and don't waste your time. All I ask for is a subscribe and like.